Welcome to the Carr and Seguin Show, hosted by Devon Carr and Paul Seguin, where two Michiganders dive into real estate, outdoors, community building, and everything in between. What's up?
What's going on?
Not much, man. It's episode 68, and we have, again, Mr. Timothy Hooker.
Dynamic Wealth Solutions.
There you go.
Yep.
That was a team partnership.
I know.
There.
Yeah, you know.
I did the name, you did the company.
There we go.
But what's up, brother, man? We always appreciate you coming on and just talking with us, obviously, about this crazy market we are seeing unfold. It's always fun to talk to you, though. So how you doing, man?
I'm well. Thank you for having me, gentlemen. It's an honor again. I'm just honestly surprised you guys are just so resilient. Episode 68. I'm so proud of you guys. That's very impressive.
Don't puff our heads up too much, okay? You know,
this is the third time I'm on the show, right?
Dude, I think fourth.
Is it
fourth?
Is it the third?
Didn't we do one in? First one was in, and then the other two were.
I don't know.
Yes. No, this is the fourth because we started during the frenzy of the GameStop AMC mania, and it was clear, smooth sailing.
Yeah.
And ever since it's been down. And so I looked at November 3rd. That's really when the NASDAQ peaked out. That's the second time I was on. Then April 6th, that's when the bear market started in the NASDAQ. So now we're here again, and then now we have a bear market in the S&P 500.
Yep. Yeah, it's been I know the first time we had you on, I'm looking at even just like where the Dow was in February of 21. We were sitting at February 12th was 31,458 and got all the way up to what, like 36 something? And now we're chilling at a 30,619.
There you go.
So we've ride some different waves. We're this climbing wave, this peak, this big. I mean, ever since like November, it's been up, down, and down, 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 down.
Yeah, and the only thing, like we said, is the only thing safe this year has been gold. But 1.8% return on gold isn't going to really make your portfolio.
Right.
No.
You got 10% in gold. It's not going to save you, but it'll make you lose less, I suppose. And then talk about some asset classes. Just corporate bonds down 16%, LQD, and then the S&P 500 in a bear market down 21% year to date. Nasdaq down 29% year to date. And then, like you said, the Dow Jones has not slipped into a bear market yet. So that's good to see, because if we have all made three major indexes in a bear market, I don't think we'll recover for that for quite some time. And if we can keep the Dow out of a bear market, that would be very encouraging.
Now, for those that maybe are just tuning in, maybe touch on the difference between a bear and bull market, and then maybe, since we kind of just talked about the Dow, where it's at, how much further would it have to drop to turn into a bear market?
Yeah, so bull market is when stock prices are climbing, and that typically lasts for many years. A bear market is when stock prices drop or fall 20% below their all-time high, and that indicates a bear market. So the Dow Jones right now is about 4% away from being in a bear market.
Yeah, I was going to say, because they're down 16% year to date, the Dow.
Yeah, and that would be just a full circle rotation into a bear market that typically lasts months, but they can last years. The recovery takes quite some time, and it's not fun to be an investor at all. But that's where the opportunities are made. That's where wealth is created in the bear market. And you, like we said before, you got to be able to run into a burning building when everybody's running out.
That's right. Got to be the hero. Heroes are the only ones running in. That's right.
Try to be the hero.
Well, I know recently, Tim, you were at some conferences. Kind of been the traveling man, as we can kind of. I think this is the most tannest Timothy Hooker we have on the show since.
Thank you.
I mean, come on. If you were in Hollywood, Florida, and Austin, Texas, yeah, I don't think in these months, in June, I think it'd be a little hard to avoid some heat,
Right.
and some sun tanning. So, but no, it's curious. I know the first. What was the last one was the ETF Inside ETFs Conference, right? Down in in Florida.
Yeah, that gathered about 2,000 financial advisors to learn about different technologies that we can use for our investment practices. So typically, you'll meet registered investment advisor owners down there, and they want to learn about how they can improve their business, but also learn about exchange traded funds. And just a quick summary, 101 on exchange traded funds. The first one was created, I believe it was 1994, and it was just the S&P 500 index. So it tracks the S&P 500 index. It's a basket of stocks, similar to a mutual fund. But the reason they created the ETF wrapper or investment style, it has advantages over the mutual fund. It's more tax efficient. It's able to be bought and sold during the day, so it can be traded. It's more liquid, and the structure has a lot less fees. So it's an open-end fund is a mutual fund, a closed-end fund is an ETF, and it's basically just a different legal structure. So it's kind of Wall Street's good at not paying taxes, so this is a way that they found out to evade or minimize tax liabilities for investors and themselves. And it's been a very popular investment product. If you just search mutual funds versus ETFs, you'll see the inflows, the assets flowing into ETFs is tremendously growing versus the assets flowing out of mutual funds is going down because it's going into ETFs. So for your audience to know what an ETF is, they're probably already familiar with it, honestly, but a lot of 401k plans don't offer ETFs, but it's getting more popular. So the mutual fund is still around, but it's more of a dinosaur way to invest because the ETF is just a outstanding product, and they don't have an inside mutual funds conference where 2,000 advisors go to. They go to.
That's what
they're missing,
right? Yeah.
And at that conference, they had Vanguard, BlackRock, all the big names you could think of advertising their ETFs, meeting with advisors, and you name it, they have an ETF for it. So that's another thing that's popular in ETFs is factor style investing. So like this year, for example, if you were in a growth factor ETF, MGK, you would be down about, I think last time I checked, it was 26% this year. So if you look up MGK there, Paul.
MGK?
Yeah, Mega Cap Growth is a factor ETF that tracks mega cap growth companies. Think Google, Amazon, companies that are trying to grow their cash flow and have prospects for the future that are different than, say, a value company. A value company would be more of a consumer staple, Johnson & Johnson style company, Procter & Gamble. So if we look at MGV, that's the value factor ETF. That's only down 9% this year. So if you were to pick an ETF, which one would you want to be down more this year? You probably want to be in MGV, but over the long term, these factors change. So at the conference, is discussing that value obviously is the favorite factor this year because you're down less.
Right.
And then they can break it down into other smart beta style strategies where they combine high volatile stocks with high dividends or low vol with high div stocks. So it's really a showcase for these investment managers to show off what types of investment funds they have. And I don't know if it's a fact yet, but they said that soon there will be more ETFs than there will be companies listed, like stocks.
Really? So it's that
Popular.
Yeah,
Yeah.
that big to where you got to be, if you're not in ETFs right now, you better be starting looking at them.
Yeah, and they can, go into more thematic ETFs. If you really believe in the future of space, you can buy an ETF called UFO, the ticker UFO, and they have like satellite companies. Sure, Boeing's in there. And they just believe in the future of space. So there's an ETF literally for everything. Paul.
I was just gonna say, there's equity ETFs, bonds.
But they don't always last. They don't always last. So there was a ETF a couple years ago. I knew this one was going to fail, but it was a pretty what do you call it? Genuine or original idea. It was the whiskey ETF. So the guy, the fund manager, just bought whiskey companies or companies related to liquor inside of the investment fund.
Oh,
and it did horrible.
It wasn't as popular as he thought. So,
wonder if Will Woodington bought it on that. Should call Will and be like, "Hey, did you buy that whiskey ETF?"
Right.
You hopefully didn't.
There you go.
Yeah, so I would look. I mean, there's an ETF for everything. I mean, real estate, currency. I mean, you name it. There's a whole list of all these different. So you could literally just make. You could make an ETF.
Yeah,
What if we made an ETF around golf companies?
That's again pretty focused, but you really got to sell it to golfers. It might work though, because investment advisors, financial advisors, their clients,
they all golf.
Sometimes.
Yeah,
but you would have to be willing to accept other companies than Titleist.
I'm okay with that if it makes me rich.
Okay.
How do we set up an ETF?
It's cost about $200,000 in legal fees. So
okay, yeah.
And then I got to hire you to manage it, right?
Yeah, certainly.
Yeah.
Okay.
And we're gonna need a golf. We're gonna need a pro to sponsor it.
Yeah.
Yeah.
It's
like
Tiger.
Barstool Sports. Look up the Buzz ETF. Dave Portnoy launched their own ETF. That was at the market high peak. February 2021, they launched that, and it was all about investing in social stocks that had big followings or Reddit style stocks, meme stocks, and I'm sure that's not doing well. Now, I've not checked.
How do you? Let's see. This doesn't look good. Oh, is this what's all in it?
Oh, you got it up, the Buzz ETF?
Yeah, where should I look it up at? Yeah, is there like a main? I just put Buzz ETF in Google. And it went to some vaneck.com thing.
VanEck's the sponsor. So the investment fund is
social sediment. Is that it?
Yep, that's it? Yep.
It's at $13.28. So what is the year over year on this?
Oh yeah, it looks like it's down 47% in the past year. That has GameStop as the top holding, Twitter, Apple. Yeah, so those are ETFs that became very popular at the wrong time.
Yeah.
And it's just this year you want to be in a dividend ETF, anything that pays a high dividend really, or value factor. If you see value on the ETF, high dividend, low volatility, those might be a good mix, better than growth, momentum, and social sentiment investing, because that style of investing, it lasted for a year. That type of strategy was great for a short amount of time, but it goes back to the fundamentals now. Companies that have strong cash flow, that are going to be able to survive the potential recession that we could go into. And in companies, I think we mentioned it before on April 6th, the ARC Innovation ETF. Companies that are trying to innovate during a recession typically aren't making too much money. So the ARC ETF, since we talked, it was at 63 on April 6th, and it's dropped another 35%.
Jeez.
So she wasn't at the conference, but
I wonder why.
her fund has been pretty much wiped off the map. All the gains from 2020 and 2021 have been erased for our.
Right.
So that's the ETF world, and there's really, you could think about it, anything you can put your money into, like currency ETFs. Then you have gold ETFs, GLD. There's the lithium ETF, LIT. If you like future of electronic vehicles, you can invest that way. So that's why I like ETFs a lot versus individual stocks, because you get to get a theme around what you're investing in, and you can build your portfolio, your core with ETFs. And it's a little bit, I'd say, more manageable than a group of, say, like 20 stocks you want to invest in. So that's, I would recommend your audience definitely look into the ETFs. Vanguard, they really do a good job of building a big basket of ETFs, and then you have other ETFs where they're just maybe 20 companies or 30 companies inside the fund, so it's more concentrated.
I'm still thinking about starting a golf one. Or
I think that's a great idea.
What if you start an ETF on golfing players?
I don't know if that one would work.
Gambling.
It's true.
That's DraftKings. Wow, DraftKings. That's a tough stock. And then Penn Gaming. That's was the big craze in 2020 when Dave Portnoy said buy Penn and invest in it. Then they got added to the S&P 500. Let's see what they're doing now. Penn Gaming has got to be down. Yeah, so they were up at, Penn Gaming was up at 117, 130 back in March 2021. Now they're at 28. That's 78% loss.
Jeez. It's a lot of money. Bye-bye. Yeah, year to date. So
just in this type of market, you want to be able to survive. You want to be able to not lose as much. And
right.
Goes back to us talking about the value ETFs, looking into recession-proof style strategies. This type of economic environment, which could lead into what we talk about next, is going to create that type of investment demand. You're not going to want to go into the innovation sector at this point in time, because it could be a great buying opportunity, but if a recession comes and it's a prolonged recession, these companies are just going to continue to bleed cash. So
right.
It's a flip of the coin.
Unless our government keeps printing cash. So then the next conference that you've attended, I just love how you are just, staying on top of education for clients, staying at the forefront of what is not only how this market is moving, but like you said, even I know at the inside the ETFs through technology and obviously networking. You go to conferences and you always come back just jazzed up, right? Because you're hearing new stuff, you got new equipment, you got new tools, you got new outlooks.
Excited to use them.
Yeah. So, what was the other one that you just came back from in Texas?
Yeah, that was hosted by First Trust. So what I like about First Trust is they're a private investment company. They're not publicly listed, so they have a lot of flexibility to be a unique investment analysis and provider for advisors like myself, and they create ETFs. So I can invest in their ETFs for my clients, and they have strategies that I believe are some strategies that are superior to, say, a Vanguard investment fund. Because if you're looking to invest in just broad indexes and mega cap value or growth style ETFs, then you're going to want to go with like Vanguard. But if you're looking for more focused strategies, First Trust is probably the company to go with and check out those ETFs. And they had their chief economist there, Brian Westbury, talk about the market and the U.S. economy and where that's at. And it's not a dog on him, but if economists and academics were so good at what they do, then why aren't they all rich investors? Because they're always predicting things and what's going to happen. So that's I still weigh their words properly and listen to them, but they have they're not always right. So for example, Westbury said that the S&P would reach, I think it was at 5,000 this year. And it doesn't look like it's going to happen.
Yeah.
So
I mean,
I
no one
bet
has
he
that
can
crystal ball.
foresee the war in Ukraine, though. That's kind of a black swan event. But
Right.
I mean, we talked about that on April 6th, and I think that war is still going on. I honestly haven't been following it, but it's not going to help our global supply chain and logistics, especially oil prices, if this war continues to go on.
Right.
Right.
Now, in an ETF, once they set it up, that's the way it stays, or can they necessarily
That's a great question.
flip-flop stocks out of it?
Yeah, so they can buy and sell and change their whole portfolio in a matter of days if they need to. So it's tactical, and that's the unique advantage of it, is that you can see also the holdings on a daily basis. So if an investment fund manager buys XYZ stock, you're going to know about it the next day.
Okay.
Versus a mutual fund, they don't have to update you regularly. It's only quarterly they update you.
Okay. Mm-hmm. Dinosaur ways.
Yes, dinosaur.
Probably old people selling them too. I'm just kidding. I don't know.
Well, it's very popular if you're a commission-based advisor. Say, for example, you have $100,000 from a client that wants to invest. I'm the advisor. I'm a commission-based advisor, and there's a fund that will pay a 5% commission and trailing fees on that. So that 5% commission is $5,000. That's going to go right to the advisor, and then you're at $95,000. So you pay the commission to get into the fund. It's a front load fee. I'm not sure if how popular it is in the registered investment advisory space, because mostly everybody that I communicate or network with, my advisory network, we're doing fee only asset management. But there's shops out there and brokers that still charge those front load fees, and that's basically not necessary with the ETF. So it kind of puts those guys out of business almost. You really don't need to pay that upfront fee, that front load fee, to get into an investment fund anymore.
I like that.
Yeah.
Yeah, it's a pitfall that some may fall into, and then a lot of those types of brokers will sell maybe too much life insurance or an annuity that it creates illiquidity for the client. So for my clients, I like to have as much liquidity as available. And an annuity, sometimes if you put it in for 8 years, that money is going to basically essentially be locked up for quite some time, and you're not going to be able to get the types of returns you want. So in 2008, annuity sales were booming because everybody wanted to be in a safe investment and they wanted guaranteed returns. But in hindsight, they should have just probably bought ETFs and rode the market back up. But again, that kind of goes against human nature. When things are really challenging, you just don't want to feel any more pain, and you want to just get some guaranteed returns when the markets are going down.
But heroes run in the building that's burning.
There you go.
Heroes.
Save people.
I I like to go against the grain. Everyone else going
You
that
do?
way. I want to go that way.
Right. So
No, I like that.
do you have some? I know you talked earlier about higher paid dividend stocks. Maybe something for people to consider at this point in time in the year. Do you have any one or two that you would recommend for people to look at?
Just looking through like SPHD, Paul, if you want to pull that investment fund up, that's done pretty well this year. It's
Which one is it again?
SPHD. So that takes a filter of the S&P 500, and it changes this top 10 stocks. They do change. So if we look at the top 10 in there, I think that collection is pretty strong. But as a fund together, it filters out low volatility stocks in the S&P 500 with a high dividend. So that's a solid, I think, recessionary proof investment. Obviously, it's not, guaranteed that it'll continue to perform that way. But another one that comes to mind is Cows ETF. So it's COWZ, and that's a uh, filter on the S&P 500 again with companies with the strongest cash flow, high cash flow.
Cash cows.
Strong, yeah. So you'll see some energy companies in there right now because their cash flow is strong.
Yeah, I wonder why.
Yeah. So those are factors or smart beta ETFs to look into that could, balance out a portfolio. If you have Amazon, Apple, Google, those tech companies, you're going to want to have some exposure to some of these kind of traditional sectors. And I mean, I still think Google is, a great company. They don't pay a dividend though, so that's where you got to know if investors just don't want anything to do with non-dividend paying stocks, then Google could stay in negative territory for quite some time because people just want to stay in that guaranteed dividend and collect that while they can. Because
right.
I mean, even Amazon, I think last time I checked, it was down 34% this year. And they had a stock split, so.
Now, if somebody was, say, I don't know if there's too many people out there, but they're just starting to get into it, maybe they had a little extra cash and they want to get into it, and hearing this, they're thinking, well, what stocks pay a dividend? Like if you went to, Google or say Yahoo Finance or something, how do you know which ones necessarily pay a dividend?
Typically, it's the more traditional sectors, but in I'd say Google Finance is the best way to see the data on there, and you'll see in the bottom corner what dividend yield it is, and just getting started. And we talked about it before. Buying stocks is probably the riskiest thing you can do. You want to try to buy the ETFs or index funds to get in there. But I do recognize that stocks can be wealth builders, but you have to be more of a timer, and timing the markets and getting in and out of the stocks is more of a
you have
challenge.
To watch it constantly.
Right.
Yeah, or just watch it go down. And we can't keep this episode going without bringing up Bitcoin one time because it's at what's it at today, Paul?
Jeez. Just looking at Amazon financials. It'd be nice to run a company where you did almost $500 billion.
Well, you think the man built a boat and didn't even measure that they could get it out. So then he's going to pay to have a historic bridge moved.
He built a book.
A book?
Yeah, it was a book.
It was a boat. It's a yacht.
His yacht?
Yeah.
What happened?
You didn't hear that?
No.
He had built some super yacht, and they built it, and to get it out, they have to go under this historic bridge, and the boat's too big. So they have to, last I heard, he offered him I thought it was $2 million or something to move the bridge or take it apart, and then I don't know if they're going to put it back together, or I didn't hear that they were fully doing it, but it was like some super yacht that, I mean, they didn't even measure to see if they could get it out.
Whose fault is that one?
I don't know, but man.
Too much money. Too much
Yeah,
money.
too much money.
Yeah.
Bezos boat issue. His $500 million yacht. What the frick? Reportedly beat for Amazon founder Jeff Bezos faces a delivery problem. It may require dismantling a beloved historic bridge in Rotterdam that is blocking its passage to the sea. Dear Lord. That's freaking hilarious.
Yeah, how would you like to make that phone call? Yeah, your boat's done, but we can't get it out.
Jeez. That you just spent $500 million? But that's like nothing.
Sure.
Your company does $500 billion. That's stupid to know that $500 million is like nothing. Nothing.
Drop in the bucket.
Right.
Yeah.
Right.
Yeah. Jeez. All right. Well, yeah.
Yeah.
I'm still, my mind's still on the golf ETF.
I'm not
It's a great
surprised.
idea.
I think it's a fabulous idea.
We just got to
Especially
get a
right
professional
now.
golfer to back it.
Huh?
We need a professional golfer to back it. And,
I want to get Kevin Kisner,
Oh, yeah.
Keegan Bradley, Jordan Spieth.
Cooch.
I'd send an invite to Matt Kuchar. Cooch. John Daly.
Anyone else?
Just to name a few.
Just
Name a few. Oh, we'll get a whole bunch of them. It'll become the largest ETF known to man, and Mr. Timothy Hooker here is going to manage it.
there you go.
It's a dream.
Another glorious
I'm going to take
idea.
you to the moon, Mr. Hooker, with this golf ETF.
You guys will have your own spaceship.
We will. Freaking, what's his face?
Be like Jeff Bezos and who's the other guy?
Richard Bronson.
Yeah.
Yeah.
Yep. There you go.
That reminds me of the space. They have a space company, Virgin Galactic. They literally are making spaceships and sending people to space. It's SPCE.
It's the stock ticket?
Yeah, I haven't checked on it in a while because I know it's getting crushed.
SP what?
SPCE.
CD?
No, E. So it's
E?
Virgin Galactic Holdings. Yeah, I remember when they listed, I was like, they have only 6 employees. How's the stock up 100%? I'm so confused.
They only have 6. Oh, it's $6. Woo!
It was at 44. I mean, once you can't go down anymore, it's at 82% down. Anymore, it's just going to 0.
No, they were at 54 back in June of last year. Holy crap.
Yeah, I don't think they-
84%. Yeah, I think you should just fold that, Mr. Branson.
I don't think they make any money either.
Revenues $238,000 in 2020.
Must have sold the ticket.
For a number of employees, 804 in 2021.
804?
Yeah.
It's
How did they
probably because
feed
they
it?
had to build the spaceship for them.
I'm sure. I don't know if those payroll checks are bouncing.
Yeah, in hindsight, those types of companies and all that was just a total mania, speculation. And I think the good thing that we can all learn from this as investors, young investors, with long time horizons, is the difference between speculation and investing. A real investment you want to see makes money. The business needs to make money. They have to have a consistent service or product that is realistic. Maybe they pay a dividend, and speculating on a space company that maybe has one spaceship and they don't even know if it works, that's not investing. That's speculating. So
Right.
I think that's what a great deal of all of us can learn from is that throughout the cycles into the future, these will probably happen again. There'll be manias and speculations. I mean, you're seeing it in crypto right now. That there's a lot of mania that was there, and now it's not. So, what an investment is versus what a speculative idea is, and goes into what one of the economists was saying at the conference is Bitcoin. Obviously, the technology, blockchain, very innovative, but as an investment, there's no cash flow, so it's basically all speculation what the future is holding for it, and it's a speculator's investment. But who's to say it can't go to 100,000 in 2 or 3 years
Right.
again?
Right.
Again, it's a flip of the coin. It could go to zero, but there's a lot of smart people betting that it won't. So it's very challenging to cipher through all this information, and that's why, as an investment advisor, I'm looking at gold, looking at all these asset classes, and we have to take some risk somewhere. So balancing out all these asset classes for the long term, I think you'll do well. But if you overweight, obviously some of these growth ones, you're going to do better. And then brings me up to just a guy with some crazy kahunas. Look up Michael Saylor with MicroStrategy there, Paul. This is probably one of the most interesting stories I've been following throughout all this mania. This man has been the CEO of MicroStrategy since 1989. He's survived the dot-com bubble, the global financial crisis, and right now, this is where his company is basically it's do or die. They have, I think, if you look up how many bitcoins they own, the company itself has leveraged debt and financial engineered themselves to own a massive amount of bitcoins. So, as a CEO, he believes holding Bitcoin is better than holding cash for their treasury reserves. So similar to what Tesla did, they bought some Bitcoin instead of just holding cash.
Yeah.
They're probably down on it now, and so is Michael Saylor down on Bitcoin. But looking at his track record as a CEO, surviving all these ups and downs, all these different eras as an investor, I think he's absolutely nuts. But I'm as a investor, I mean, he's telling people to leverage their house and sell everything they can to buy Bitcoin, which is absolutely reckless. But as a CEO, I think he's doing something for his company that could make it, survive another 10 years. Because if you look on the spectrum of when he was publicly listed, I think MicroStrategy, if you zoom out there and do the all-time chart on Google Finance, their ticker is MSTR to the max. So he listed his company in 1998 on the NASDAQ, and it's been listed on there, since, through 3 decades. He's survived. One time, his stock was trading, over $1,000 up to $3,000.
$3,100.
170 now.
Yeah. It was $3,100 back in March of 2000. I mean, for a very short period, I mean, it just skyrocketed.
And isn't the recent phenomenon look very similar to what happened? It went up to like 1,000 a share. That kind of blip in the chart.
Yeah. It is funny because back in 2000, from what, 99 to the end of 2000, dude, it was in a matter of months.
So right now, yeah, their stock has been totally crushed this year because as of, I think, June 13th, they're down about $1 billion on their Bitcoin investments.
Wow. Jeez. Yeah, they're showing a negative 130 million in net income. I wonder why.
Yeah, they have 129,218 Bitcoins.
How
and
much?
they're 129,218 Bitcoins. Their average price is 32,000 a Bitcoin. So he's making a massive bet on this asset class that it's the future. And if we look back on the internet, the dot-com bubble, you had tons of companies go out of business, companies that didn't survive. But the ones that did, like Amazon, was at $7 a share, and until recently, it went up to 3,700 and fell. Then they had the stock split. But if you're able to look at, I think he has a unique lens of how he thinks long term, and he thinks a lot longer term than most people are capable of. So
Yeah.
it appears that he's doing something reckless with his company, but I think he's smarter than most people, and he's going to figure his way out of this.
Mm-hmm.
And that's just a very interesting story about how public markets are tied to Bitcoin.
He's the biggest corporate holder of Bitcoin. Yeah, I wonder how 2,100 of his employees feel about it.
Oh, scary.
Yeah, we couldn't go a show without talking about Bitcoin.
Right. Yeah.
No, it's just wild
It's
though.
very
like,
interesting.
This guy goes. I mean, it's a very interesting chart to look at. If you ask me, I mean, you have this graph that just opens at 200, shoots all the way up to 3,100, drops. I mean, 3,100 at. I can get it to stop. It's so small, I can't even do it. March 10th of 2000, and by April 20th, 40 days later, he's down to 387 a share. Like, what the? How does it happen? There wasn't some huge crash in 2000, wasn't there? No.
Yeah, the dot-com bubble.
Oh, really?
Yeah.
And then it's just been riding forever at, like, it fluctuates from 50 to 140 bucks from 2000 all the way to about 220. September of 2020.
And it's happening again. His stock went on a massive run up, and it's coming down. And then now we look at the stock market as a whole. History seems to repeat itself in different various ways. And you have, if the year was to end now, it'd be one of the worst years in stock market history since 1931, I believe. So it's the NASDAQ is that tech heavy index where there's no financials in it. X financials, the NASDAQ 100 tracks the fastest growing 100 companies in America, and that index is down significantly this year, 29%. And then in the dot-com bubble, it drew down, fell about, I think, over 50% from its high. So it just shows you that the NASDAQ 100, it could go and fall significantly more, and that all indexes could fall even more, and the Dow Jones could slip into a bear market, and that'd be the worst case scenario.
Right.
At that point, I think you'd have unemployment pretty high, but right now, if you look at it, stagflation, what they call it, where you have a economic kind of decline, where you saw last quarter we had a GDP print that was negative. We have high inflation, but the unemployment rate right now is 3.6%, which is very low. So that's encouraging. And I think the only sectors that are feeling it most is like these software sectors. We talked about Carvana before. I think they laid off 25% of their workforce.
Huh.
So the tech sector is definitely feeling some pain after the pandemic. People are spending less time on their screen. They're not, spending as much time gaming as they were, and the economy has shifted where you're not going to really just go for a cruise and burn some gas. You're going to be conscious of your spending,
Right.
and that's where the consumer sentiment comes in. It printed its lowest ever. So University of Michigan tracked consumer sentiment, and the consumer right now is pretty pissed off that this is happening. This high inflation, everything is so expensive. So they're not spending as much money, and that's
Right.
going to slow down the economy. And you see stores like Walmart and Target have super high inventory because they just they thought the consumer would keep buying things and keep buying things. But now that that story is over, experiences are what consumers are shifting towards. Hopefully, that will help the economy, bounce back here. But if we have another GDP print that's negative, that comes out in July, then we're going to be in a certified official recession.
Certified.
Certified.
Official. Yeah. I mean, obviously with Feds increasing interest by 75 base points and saying that they're going to do it again in June, right? No, July. We are in June. July. I mean, you have to do it with the recession.
It's the only thing that curbs inflation.
Correct.
You need to slow it down.
Yeah. So I mean, it's not a horrible thing, unless you want to just keep paying more, more for everything. Got to cool it down a little bit.
Yeah.
And I mean, that's the going says is everything is not everything, but there are a lot of options that are pretty low right now. And if you do have some liquid cash, and it's not a bad time to buy. I don't think.
I would say it's a generational buying opportunity. Could it go down another 15% in the NASDAQ? Yeah, but we're not going to try to, time the exact bottom. So that's why you got to take some steps in and be confident that in the future that these prices will go higher as the indexes go higher. But there will certainly be sectors that don't recover.
Mm-hmm.
Like jets, the airlines ETF, that hasn't recovered since the March 2020 wipeout. Airlines are, facing higher oil prices. They have it's a tough business model, honestly. It's a luxury good. And if there's a recession, people aren't buying luxury goods.
Right.
Luxury goods and services.
That's kind of the unique thing, though, about this whatever you want to say, situation, recession, whatever. Gas is so high, but yet so is airlines. Like, which one do you take? Right? Like, it's you're like, well, I'm not going to fly. I'm going to drive. Well, I'm going to walk.
Right.
I'm going to take an extra week off of work so I can make it there.
Right.
It's funny you say that. I do see a lot more people on scooters and like.
I was just going to say the moped.
Yeah.
Saddle up.
Like I saw a guy. I live kind of out in White Lake area, and it's a little bit more rural. And you see just a guy on a scooter or moped, and like you wouldn't have saw that when there's $2 gas.
Right? Yeah.
No.
Kind of like dressed up. You just don't see that.
No. Taking the scooter in for work today.
Any way you can, right?
Hopefully he's not down a dirt road.
Yeah,
it's had to wear a white dress shirt to work today.
That wealth effect when your 401k goes down 15-20%, and the wealth effect, people don't feel as wealthy, even though they weren't accessing that money. They don't have that kind of statement that's giving them peace of mind. So they're going to be like, well, we're going to have to cut some costs here. We're going to have to ride the moped to work and things like that. But that's what companies are doing too. They're laying off workers. They're finding ways to lean out and have a more stronger balance sheet essentially. Right. So that means cuts. That means not investing as much in growth because they're being more in defensive mode, and that's going to slow down the economy too.
Yeah, be interested to see how long it rides.
Hopefully fall it turns around.
Yeah,
hopefully.
What comes in the fall? Oh, Christmas
hunting season.
Yes. That's not. You know what? That's not even far away. I was just actually we were, the wife and I were going over our calendar. And I'm like, holy crap. I mean, antlerless is like in 13 weeks.
Yeah.
That's going to be here before you know it. 13 weeks is like nothing.
Right.
Not anymore.
Blink of an eye.
A month is a blink of an eye. I mean, it's almost already July. I thought that's why I was just saying, like, the Feds are going to release in June.
Right.
Oh, wait, no, it's already is June.
Right.
Time flies by.
Mm-hmm.
Yes,
You got to
sir.
have the outlook like Michael Saylor. He's always looking.
Wow.
Oh, yeah.
Key takeaway.
Think like Michael.
Yeah.
The
He's
long
a
distance
billionaire
outlook.
too. He's a billionaire, and he got that way by thinking long term. So it's like, well, maybe I should start doing that more. And how does he survive so many, so much turbulence and recessions, and his company's still in business? It's just
Right.
It's impressive.
Well, I think it goes back to, I think one of my favorite quotes, and maybe not a huge fan of the guy personally, Jeff Bezos, but he always says, like, we're going to fail. If we have the mindset that we're not going to fail, that's when we're in a bad position. But when we think like, hey, we're going to fail at some point. So it's almost, I mean, it's not to say like that's how you should think about your investments, but at the same point, it's like, even when you're up, like, hey, there's going to be a time when things are going to get down. So let's take what we have and hedge for that time and then ride it out. And who knows? Maybe that's what he did. Maybe he was just when stocks was trading at $3,100 a piece, stuffing that money away for that little crash coming. But
his wife did. You saw his wife sold basically all her shares.
Did she?
Yeah, if you look that up, she got out right at the top, the market, when she divorced him and everything.
Smart woman. She said, hey, this is the top. I want a piece of the top. There you go. But yeah.
Jeez.
Yeah, I would say for your audience, the key takeaway here is, surviving, creating a recession-proof portfolio, looking at high dividends, balancing out your portfolio with some gold, and then looking towards the future and seeing that you should have some of your portfolio in some bets that you think are going to be a long-term winner.
100%.
Is that Bitcoin? Is that Tesla? Is that ARK? We can't know until it happens. So that's why we have to stay invested in some of these growth positions, because you can't benefit from them if you don't own them, and then trying to buy them after they rebound, you don't even give yourself the opportunity. So just my job is to balance the emotions of my clients and investors, and make sure that we're not getting out of the market, because if the market rebounds, then we can't afford to buy all those shares back that we sold. So that's a very delicate balance that we're working with. But yeah, I hope next time we get on, we're in a bull market, because episode keeps going down.
Well, should I mean, according to our chief economist here, Devon, he says the fall. What's the first day of fall? Is it in September? No, it's too early.
Yeah, I think.
What's the first day of fall? Let's see. Yeah, September 22nd. What day is that?
That's when everything's gonna turn around.
Right.
It's a Thursday. Yep. So we're gonna have you on September 7th. So then that drops on September 21st.
Wow.
And we're
like this.
and we're gonna see if our CE here.
That's not fair.
Why?
What's not fair?
What's not fair?
Fall's a general term, so it could be. I didn't say it was first day of fall.
Well, I mean, it's less than 2 months. Jeez Louise.
I know. That's why
you're
not giving me much.
3 months.
You're not giving me much room here.
It's a quarter. We'll see what happens in the next quarter. I'm confident.
And I'm confident too. I wouldn't be in a big
I'm confident too, Paul. Yes.
It brings me up. One of my last points is that we could go into a recession. You could have all the headlines say recession, and the stock market at that point could find the reversal, and we could be 2 months into a rebound that we don't even know that we're out of the bear market yet. But then if you miss it and you try to pick the time and you
You're
wait
already
too
late.
late, then you're going to miss the best rebound ever.
Yep.
But there are times in 2008 where the market dropped about 50% there, and in between, when the market dropped 50%, you had 5 separate rallies of 15% more.
Wow.
So that's where it's kind of like a suckers rally, they call it, or a fake out rally. And investors think that we're getting back into a bull market, but we're not. So that's what investors should worry about right now, is that trap, to jump all into the market at one point. And that's where I think you got to look at it quarter by quarter, and but also be confident in what you're buying and
Yeah.
stay invested.
Yeah. Get a little risky. I'm sorry, that's just me. Obviously, I'm not a very. I'm a risk taker. But I agree with what you just said there, Tim. It's like, you got to have a little risk, because like if you're not playing some of those cards where it's like, okay, I'm going to put a bet on this ETF or that company or this whatever, like you're just being too conservative, and then you're going to miss it when it rebounds because you didn't get in. You didn't
Right.
at least put a couple little more riskier plays on the table to, like you say, you want to have a balanced approach that obviously is geared towards each client's goal. But at the same time, like, I think now is not the time to be like super conservative. That's what I don't feel like. I just think this media, like everything in the last decade of our lives, is overhyped, and it's never as bad as it seems.
Like, good point. That's a good point.
Know?
Yeah, I like to turn off the TV and have dialogue like we're having here. This is real talk. We're not pushing any kind of agenda on anybody, and this is some homegrown roots news right here, bro.
Right. No, I think it goes back to even to one of your the last time we had, you were big on energy. Like I remember you just saying it multiple times, like focus on energy. Energy's strong. Energy's looking good. I mean, hello, like frickin' A. Why is that one ETF that you mentioned just packed with frickin' oil companies? Energy. I mean, they're cash heavy right now. Tech is just kind of getting obliterated right now. So look to the things that are going to climb afterwards and get something in there. Get a little both.
Mm-hmm.
Right. So energy I think his energy XLE ETF at one point was up like 50-some% this year. And next year it could only be up 5%, and we could have technology up 20%. So the years kind of go out, but yeah, you got to have some.
And they're always balancing each other out. Even if this one's down, but this one's up, well, hey, we're still hovering around that nice, 10, 15, 20% return. Yeah, let's go. It's good money.
Yeah.
Mm-hmm.
Let's keep it rolling.
In a 60-40 portfolio, the worst returns on record, 60% stocks and 40% bonds. As we talked about, corporate bonds and aggregate bonds are down significantly. So even if you were a conservative investor coming into this year, it's really hard to escape losses or come away without any losses at this moment. But hey, we could be in this bottom right now. We could have, if you woke up on January 1st, saw where the stock market is, then you woke up on the end of the year in December 31st, and maybe the S&P 500 is only down 5%. You could just, what was everything in between? Everything in between really didn't matter. It was just noise.
A bunch of loud noise, yeah.
Yeah.
And that's what I think I'm talking about. It's just media just makes it freaking noise. Yeah. Noise. It's like, just shut up and call Timothy Hooker. He'll tell you what's up. He's the man on the road. He's suntanning in Florida. He's at conferences, learning every day, getting better for his clients. And that's who you want to work with. That's who you want to put your money with. Someone who's getting out, networking, talking to people, making sure that your investments are in good hands. And they are.
Right. Now, for those that haven't been on or listened to the show before, since you've been on it, how do they get a hold of you?
Well, my phone number is 962-5448. But MrTimothyHooker.com, and then our corporate website, godws.com. You can book an appointment on there, and just have a conversation with me, 15, 20 minutes, talk about the markets, talk about what you're doing to invest. And a lot of times, what I do for clients is, I'll take a portion of their investments, an account that maybe.
Oh, we lost him.
Did we lose him? Well, so we lost Tim.
Yep.
We lost connection on him, but so we'll repeat just again, Mr. TimothyHooker.com. That's an easy way to get a hold of him. Always a good time having him on the show anyways, talking about just the market and where it's heading. So it's always learning something.
Mm-hmm.
That ETF stuff is always interesting. For a while there, I'm just like, what the frick is an ETF? You know? But no, good stuff.
Yeah,
so,
absolutely.
But till next time, I'm Paul Seguin with eXp Realty.
I'm Devin Carr with Gold Star Mortgage.
This is the Carr and Seguin Show. See ya.
The primary purpose of this podcast series is to inform, entertain, and educate. The information, opinions, and recommendations presented in this podcast series do not constitute legal or professional advice, opinions, or endorsements of any kind. Gold Star Mortgage Financial Group, NMLS 3446, Equal Housing Lender.